Hello viewers, welcome to Certified Business Solutions, where we discuss about business-related matters. I will be your host, Lucy Maina, and with me is Dr. Kamau. Today, we are going to talk about inflation. What is inflation, what causes inflation, and how it affects the economy to the level of the common mwananchi. How are you, Dr. Kamau?
Fine, thank you. Good morning.
Good morning. Do you want to say hi to our viewers?
Yes, I would like to say hi to our viewers.
Okay.
Good morning, viewers. My name once again is Dr. Alex Kamau. I am a certified public accountant, certified secretary, and I'm also a holder of doctorate degree in business administration. For the last 15 years, we have been offering solutions to businesses in terms of finding out what problems are ailing the businesses, and we analyze those problems, we diagnose those problems, and eventually we come up with a solution. So today we'll be discussing what causes inflation and whether inflation is a good thing or not. And to answer that, to leave you with a question is I would want to put it to you. You consider that compare inflation with salt. That for you to have a good meal, you need to have salt. But if you put too much salt in your food, it is not a good thing. It will now start becoming a nuisance to you. But again, if you have no salt at all in your food, then again, the food is not appealing. So just like that, you need a moderate amount of salt in your food is the same way that you also need a moderate level of inflation. Too much inflation is a bad thing. And I will tell you why. No inflation or too low inflation, again, is a bad thing. And I will tell you why. So don't change the dial. Stick with us and you'll get to know all that I have explained. Thank you very much.
You're welcome. You can start us off by telling us what is inflation?
Yes, inflation is the persistent increase in price of goods and services, usually over a period of 1 year.
Okay.
For instance, today is on February. The prices of bread, if we can just take a few items, something like a loaf of bread, a packet of milk, and a packet of wheat flour. What it is costing today will not be the same price it will be costing 12 months from now.
Okay.
So inflation is that persistent increase in price of goods and services, usually over a period of 1 year.
Okay.
And it is computed through something called the Consumer Price Index. And Consumer Price Index, we take a basket of commodities, like now the way you have said a packet of milk, a loaf of bread, and a wheat flour. So we check how much does it cost today and how much it will be costing after 1 year. Okay. Or how much it is costing today and how much the same was costing
1 year ago.
1 year ago. So for instance, to put it into perspective, assuming a packet of milk is costing 10 shillings today, it's just an hypothetical example because it is not the reality. Yes. And a packet of unga is costing 10 shillings. The other one we had said a packet of loaf, a loaf of bread, 10 shillings. So a packet of milk, a loaf of bread, a packet of wheat flour, each is costing 10 shillings each. So for the three of them, we have 30 shillings. Up to there, we are okay.
Yes, we are.
Now, let's fast forward to next year, a time like this. February 2024. Now, the price of a packet of milk has increased by 1 shilling. It is now trading at 11 shillings. A packet of a loaf of bread from 10 shillings to 11 shillings, and a packet of wheat flour from again 10 to 11. So we have a total of 33 shillings. From 30. So now this is the formula for calculating inflation. You say the current price for all these commodities is 33 shillings. Let's less the original price for all these commodities, which is 30. So we say 33 minus 30.
You get 3.
We get 3. Then we say 3,
Yes.
that is the change in price, divided by the original price,
Which is that.
which was 30,
Okay.
then multiply by 100.
Okay.
So you say 3 divided by 30, we have 10. Then from 100, we cancel 10, 1, then we are left with 10. Basically, it is 10%.
Okay.
It seems you never attended the
attended the class.
Francis. Even
No, I would
yes.
have just done a 0.1 times 100.
You know, as our time we used to use mathematical tables.
Okay.
And I think your generation is the one for using log tables.
Yeah.
No, calculators.
Yes, yes.
So we have seen inflation now would have increased from where we are to 10%.
Yes, with that small margin change.
10% is a lot of margin. It's a huge margin. Yes. It's a huge margin, because assuming that that 30 shillings,
yes,
you don't consume it today,
yes,
and you decide to put it in a savings account,
yes,
in a bank, how much do you think the bank will pay you in terms of percentage? If it pays the most, it will give you 3%.
The bank?
The bank. That's the interest rates that the banks offers to those people who have saved with them. So 3%.
Yes.
So if it was 30 shillings,
yes,
then 3% of 30 shillings is how much?
10. Is it 10?
No. It's not even 1 shilling. Because 10%
yes,
of 30 shillings is 3 bob.
It's 3 bob. Wow. And we're talking about 3%.
Yes, so 3% is about 1 bob. So if you put your 30 shillings, yes, and you deposited in KCB Bank, Equity Bank, yes, Standard Chartered, or whichever the bank, and they were to grow that money by an interest rate of 3%, yes, you would have that 1 shillings after 1 year. And the commodities, the prices of commodities would now be requiring you to top up. Yeah. Those commodities are now costing that 3 shillings. So that's why we advise our clients, yes, and the general public, yes, that when you are investing, yes, or you are saving, yes, ensure that the rate of return that you are getting from that investment, yes, is higher than the rate of inflation.
Okay, so if inflation is at 10%,
yes,
you should invest in a place where you'll get a return of more than 10%.
More than 10%. But we usually do that. We don't do that.
We actually don't know.
No,
that's why you're here for us.
Yes, and that's why our mantra for, yes, Certified Business Solutions, yes, is when you know better,
you do better.
You do better.
Okay.
You do better. Yes. You do better. So that's how we calculate we calculate inflation.
Okay.
And there's a concept called the time value for money.
Yes.
Time value for money is that with the time, yes, the purchasing power of money gets eroded because of that persistent increase in price of goods and commodity. Yes. If you just put like there, you are saying 30 shillings somewhere, you don't use it. Yes. So next year, a time like this, it will have lesser value.
Yes.
Lesser value.
That is true.
Yes. So that's how inflation is calculated.
Okay. Okay, I get it. That is
inflation. The way we calculate inflation.
Yes.
Now, I can tell you the 2 types of inflation, because we have 2 types of inflations. Okay. Inflation.
Yes.
And anything that you ever discuss about economics, yes, there are 2 sides of it.
There is never one side of it.
There is never one side of it. Okay. We have the supply side of it. Yeah. For instance, if I don't know whether I have a pen today, assuming I can grab my phone. Okay. Assuming this phone. Yes. This phone has the supplier, the supply side of it. Yes. The supply side of it and the demand side of it.
Okay. So on this side there is supply.
There is supply.
The other side there is demand.
There is demand. The supply side of it are those factors that affect the production of this phone. Okay. Because remember now we are talking about the prices. Yes. And when everything is at par, yes, when we have supply being matching demand, supply being equal to demand, yeah, then we are at equilibrium.
Okay.
everything is okay.
Everything is okay.
We don't have inflation.
Yes.
You get the point?
Yes.
But now,
Yeah.
when now the supply, for instance, the number of units required by being demanded
Yes.
by the customers of this company,
Yes.
if the number of units being demanded is more than what this company is able to produce,
Yes.
then we have more demand and supply is low.
Supply, yeah.
What happens?
The price of the phone will go up.
The price of the phone will go up.
Yes.
So that is the supply side of this commodity.
Yes.
So what affects supply? What would make us what would be the cause of a situation whereby the demand of this product
Yes.
is high, the demand is high,
Yes.
but the supply is low?
Maybe because people have money.
Because people have money,
Yeah.
and maybe
Or
the
even the production, the cost of production, maybe it's a bit high, so they are not producing enough commodities.
yes, but let's it's good answer. Now, what is static this side?
Yeah.
What is static is the supply.
Yes.
The demand is the one that has changed.
Yes, it has
So
gone up.
it has gone up.
Yeah.
So maybe you can start by asking what would cause the demand to change. As you have said, increase in the level of income.
Okay.
Maybe the economy is at boom. It's experiencing expansionary fiscal policy.
Yes.
The government probably has reduced the tax rate.
Okay.
The government has reduced the interest rate.
Yes.
So people are able to borrow money
Yeah.
at a cheaper rate.
Okay.
Maybe the government is doing a heavy government expenditure.
Yes.
It's constructing roads, the infrastructure, the SGR.
Yes.
So it is able to employ people, and people have money. They have high purchasing power. Yeah. So all of a sudden, there's a lot of money in circulation.
Yes.
But the demand, this other side,
yeah.
it is static.
Yes.
It has not changed. Because maybe this
the
issue,
demand or the production,
the demand of money is the one that has gone up.
Yes.
But the production of this phone is static. It is still the same.
Okay.
So what needs to happen? Yes. Now we need to do something on this side of the production, yes. of the supply side, so that it can also grow. Yes. But you will notice something, that in the short run, everything is fixed. But in the long run, everything is flexible. Okay. For instance, yes. If you are a Shylock, or you offer loans to people, to your friends, to your colleagues, yes. And I come and I say, I want to borrow 1 million from you today. Yes. You may not be able to meet that kind of demand because you are not ready for that kind of customer. Yes. So your production, your supply of that commodity is fixed, yes. In the short run. Yes, yes. But in the long run, nothing is fixed. Because now you can go to the bank and borrow. Yes, yes, yes. You can even sell your piece of land that you have it somewhere. So in the short run, everything is fixed, but in the long run, nothing is fixed. Okay. Even us, in the long run, in the short run, we are here. Yes. In the long run, we will all die. Yeah. So now the demand has increased. Yes. But in the short run, the supply is very rigid. Assuming it is the demand for maize that people now are asking for more. They are consuming more units of maize flour. Yes. But now here, there's nothing we can do to increase maize flour production, because we need to cultivate and do more farming. And when you do farming for maize, you need to wait for a period of at least 9 months. So until 9 months are over, there's nothing we can do about it. Yes, yes, yes. And if there are no rains, there's nothing we can do about it. Yes. So that's when now, because supply is very rigid, yes. It is not changing in the short run. So the government has only one choice, yes. To regulate this other side of demand. Okay. And that's why now the government comes, yes. And increases the interest rates. Okay. So that now it can pull out the excess liquidity of money, yes. In the economy. Oh, okay. So when the interest rate is increased, yes. People will borrow less. Yes. They will borrow less. They will borrow less. Yes. So that's one side. That's one type of inflation. Which is demand driven. Okay. Now, this other side. Now let's talk about this other side of supply. Yes. When inflation is caused by the supply side. Inflation, again, we said it is persistent increase of price of goods and services.
Yeah.
Now, the supply side,
Yes.
because of the components, the raw materials that are required to prepare this phone, or maybe if we stick to the issue of the maize meal, the raw materials that are required for a company that manufactures
plants maize
or manufactures maize flour.
Yes.
That company requires what? It requires maize as a raw material. It requires labor. It requires fuel for milling. Now, packaging material, marketing. So the cost of raw materials have skyrocketed. The cost of wages have skyrocketed. The cost of milling because of energy and oil has skyrocketed. So from the supply side of it, now we have to increase the price because the cost of production have increased. You get the point?
Yes, I do.
So the cost of production has increased. But this other side of demand has not changed.
It is still the same.
It is still the same. But now this side, the producer is saying that I have to increase the price. Because the cost of production has gone up.
High,
Now that's when we say the inflation is the inflation is not supply, but we would say it's cost driven.
Cost driven.
Yes, cost driven.
Okay.
Not because of increase in cost of production. Now the price cannot remain the same. So the producer increases the price, and now the consumer has no choice but to take up the new price. The inflation comes in. So inflation can happen to two. When now there is it's been caused by the demand side of it or by the supply side of it. And the supply side of it, we are talking about the raw materials, the labor, the cost of production in terms of energy, oil, and all that. So two types of inflation: demand driven,
cost driven,
and cost driven.
Okay, Dr. Kamau.
Yes.
As we wind up, you have not told us about what the government can do about the cost driven inflation. Yes.
Cost driven inflation.
Yes.
In terms of demand driven inflation, we saw the government increases the interest rates so that it can lower the amount of liquidity in circulation.
Yes.
Now, in terms of cost-driven inflation, the government has a few options, though it's a bit painful for the government because if it is cost-driven inflation, the government, for instance, production of maize flour. When maize flour, the prices of maize flour has continued to skyrocket. So the government has come with two solutions. Number one, and we saw it somehow backfired, is to provide a subsidy. To have an agreement with the millers and say for every 2 kg packet of maize flour, if it is costing you 150 shillings to produce, and you need to sell at 180 so that you can get some price margin, some profit margin. Now, we will subsidize your cost of production. So don't sell at 180. We as the government, we will be paying 50 shillings for every 2 kg packet of maize flour.
No, to the
millers. To the millers.
So that they can sell at
130. 180 minus 130. We have said the production cost is 150. The millers need to add 30 shillings for profit 180. But now the government feels that is too much for the consumers to handle and to manage. So the government says we will provide a subsidy. And for every 2 kg packet of maize flour, the government will be paying 50 shillings to the millers. So that's some sort of subsidy. And it is the same way the government at some point was providing subsidy for fuel.
Okay, I think it even happened when we are nearing election last year.
Yes.
The maize flour.
For the maize flour. And
but it didn't last long.
It didn't last long.
It is not sustainable.
It is not sustainable.
Okay.
It is not sustainable because the government already it is overstretched in terms of in terms of the debts that it needs to pay, and it shouldn't be giving subsidy. It should be prioritizing how to pay these debts. So if now the government decides to give subsidy,
Yes.
its ability to repay the debts will be highly compromised.
That is true.
So there is a time that now the government, to control that inflation,
Yes.
cost-driven inflation,
Yes.
it provides a subsidy.
Okay.
Is it sustainable? I don't think so.
No.
The same thing like now, the junior secondary school,
Yes.
the government has provided a capitation of 15,000 per year per every child who is in junior secondary school.
Yes.
That is some sort of subsidy.
Okay, okay.
And now you can imagine the number of children that we have at that level, almost 1 million.
Yes.
So the government is incurring 15,000 times 1 million.
Wow.
And that is the money that probably the government should be prioritizing
to pay the debts.
To pay the debts.
Okay.
So one way of managing the inflation is for the government to provide subsidy.
Okay.
Number two,
yes,
the government, especially for the cost, in order for the government to lower the cost of production
yes,
for things that are imported from abroad.
Yes.
For instance, there are some raw materials that we import from abroad and are used by manufacturers to produce some of the commodities and products that we use here in Kenya.
Yes.
So when the price, when the exchange rate
yes,
for the dollar vis-a-vis the Kenyan currency is high
yes,
in favor of the dollar,
yes,
then the cost of importation
is
high.
Yeah.
And that means those raw materials that are acquired from outside, their prices also skyrocket.
Yeah.
So for the government to regulate the prices of those commodities, it would want to appreciate the value of its currency.
Okay. To
make importation cheaper.
Okay.
So, for instance, if the dollar right now is trading at 133 shillings against the Kenya shilling,
yes,
you need 133 shillings to buy $1.
Yes.
Now the government would appreciate the value of the Kenyan shilling and ensure that every importer, every manufacturer who wants to access the dollar, accesses the dollar at 120 shillings instead of 133 shillings.
So how is that possible?
The only way the government can do that is by providing supply of money in form of dollars, denominated in dollars.
Where will they get that money in dollars?
Yes, the government is supposed to have foreign reserves.
Okay.
A good amount of it at CBK, so that when the demand for dollar is so huge,
they release the dollar.
To the economy, and of course they release the dollar to the economy through the commercial banks.
Okay.
And you understand, CBK is the one that controls and regulates all commercial banks.
Yes.
So if commercial banks say that there is a huge demand for dollar, and they have a little supply of dollar units, then they tell CBK, hey, we are struggling to satisfy the demand for dollars. So now the CBK is supposed to go to the reserves it has for dollars and give it to
the other banks.
to the CBK. But if the country like it is right now, we don't have enough dollar reserves. Actually, at any given point, we are supposed to have enough dollar reserves that should be able to satisfy the need for the cost of importing goods and services in Kenya for at least 4 months.
At least 4 months.
4 months. Okay. So, for instance, if we require $100 billion, or maybe let me say $1 billion in a month to import goods and services from abroad, then the reserves that we should be having at CBK is
at least $400
billion.
Okay.
But right now, and that is the recommended threshold by IMF.
Okay.
Right now, we are below that threshold.
Okay.
So we have less dollar reserves than can sustain our imports for a period of 4 months. Okay. So we are trending on a dangerous zone.
Okay.
And that means the government is not able to intervene in terms of appreciating the value of the Kenyan currency against the dollar. Okay. And that's the only way we can be able to do what? To regulate the cost-driven inflation. Either providing a subsidy, the government hurts. Either appreciating the value of our own currency against the dollar, but the government right now doesn't have that capacity.
The government is ailing already.
It is.
So there is
it is.
nothing much it can do to
There's nothing.
Kenyans?
There's nothing much it can do. So now,
Yeah.
the effect. Now we have said it's God for us all,
Yes.
and each one of us to ourselves.
For himself or herself.
They say God for us all and every man
For himself.
for himself.
Yeah.
No, that's where we are, unfortunately.
Okay.
So the individual,
Yeah.
the price of unga, a year ago, you are buying it at maybe 120.
Yes.
Today is 220.
Hey, and 50.
And your salary
Yes.
has not increased.
Yes.
So what happens is that the standard of your living
Yeah.
has declined.
Yes, yes, yes.
And your cost of living
Has gone up.
has gone up. Whenever your cost of living goes up, zinakutana katikati somewhere with your standard of living as it goes down.
Yes, yes, yes.
And your purchasing power also reduces.
Reduces because there is no money.
There's no money. So for you,
Yeah.
nothing much you can do. But probably if you're a business person,
Yes.
you can, if you're an employed person, for instance,
Yes.
you're an accountant,
Yes.
instead of relying on that income from your employment,
Yes.
you can be doing some side hustles.
Okay.
Maybe over the weekend on Sundays, instead
Yes.
of relaxing on Sundays,
Yes, yes, yes.
you offer some tax services somewhere,
Yes.
some consulting services somewhere,
Yes.
so that you can be able to fight the negative effects of inflation.
What about a business person?
A business person, it's a bit easier for a business person.
Yes.
Because like now, when we said the cost of production for maize flour increased,
Yes.
because of the cost of raw materials going up.
Yes.
You remember the scarcity, maize scarcity, then price of maize flour going up,
Yes.
of production.
Yes.
Now, the business has an easier way out
Than
an individual, an easier way out than an individual. Because what does it do? It increases its price, the price of its commodities, the price of its products.
Yes.
If the maize flour is costing, the cost of production is 150, the millers, the producers, the manufacturers, they will just push that cost to you as the consumer.
But can the production itself be affected such that they can lower the production?
Yes.
Now that there is no buying power for the consumers.
Yes, exactly. That's what happens. Because now the business, the manufacturers have no choice but to increase the price of their products.
Yes, yes.
But if the consumer, the common Wanjiko, has no purchasing power to buy that, then he will not buy. He will not buy. And if she doesn't buy, the manufacturer will not continue to produce.
Produce that amount, will reduce the production.
Will reduce the production.
Reduce employees.
Automatically, the number of employees will be affected. So the number of employees will go down, and now we are starting another downward spiral.
Okay.
So it is in the interest of the government to ensure that it does something to control the cost.
That we have enough salt in the country.
That we have enough
salt in the country.
Salt in the country.
You talked about the salt thing in the food.
Yes,
Doesn't
yes,
have to be high.
Yes.
Doesn't have to be.
It to be low.
So when
moderation.
When it is moderate,
yes.
How do you compare it with inflation?
When
because you said the inflation should not be high and should not be low.
Yes, the inflation should not be, because we need some bit of inflation, so that also to encourage producers and manufacturers to continue producing.
So that the economy will continue booming.
Yes, and when there is inflation, it means there's that demand for their goods and services. What they are producing, there's demand for it.
Okay.
So if there is no inflation, actually it is negative inflation, which is called deflation.
Yes.
Then it means the producers and manufacturers, even if they produce goods and services, there is no demand for their goods and services, their products. So we need some bit of inflation to encourage producers.
The production equals the demand.
Not really. Demand is supposed to be slightly higher than production. And that's what we are talking about inflation.
Okay.
Because when we are at par, production equals demand, then there is no inflation. But now demand needs to be slightly higher than production, so that now the manufacturers, there's an incentive for them to produce to catch up with the demand. If demand is lower than production, then they cannot continue producing
because the demand is low.
They will wait for demand to catch up.
Yes.
But another way that a government can be able to control the cost-driven inflation, again, it does that by hurting its own people. Like the case of maize flour.
Yes.
What did the government do? The government was threatening to import GMO food.
Yes.
GMO maize.
Maybe it is
yes.
already in Kenya.
It's already in Kenya.
Yeah.
But it was a good tactic. You know, you remember we spoke about supply being static,
Yes.
being rigid in the short run.
Yes, yes.
That there's no way we can increase supply unless now there's a rainy season, and we have to wait for 9 months for the maize to be planted and to germinate, to go through that value addition chain. Now, but now the government has another option.
Yes.
It can import GMO maize and boost the existing supply.
Okay.
And once the supply is more, then it will put a downward pressure.
Yes, on the buying,
the demand.
The demand, yeah.
And the price of maize meal. Because supply is more, now the prices will come down. But it cannot do that without hurting the Kenyan farmers.
Yeah.
Remember these Kenyan farmers, they were waiting for the maize, they were waiting to harvest their maize.
Yes.
And this maize, this production, this harvest that they were waiting for, the raw materials that they had used were very expensive.
Yes, yes, yes.
The cost of fertilizer, you remember, it was very high.
It was, yes, it was.
Yes, so they should be, there was that now, it was very controversial because the farmers, they don't want the government to import maize because it will reduce the prices of
the
maize in the country. And when the prices of maize is reduced in the country,
they will sell at a loss.
They will sell at a loss. Yeah. So the government is trying to is working.
Balance,
it is a very tight balancing act for the government.
Yes.
Do you side with the farmers or do you side with the general public? If it were you, who would you side with? Or maybe it is for the viewers to tell us.
Yes, I think the viewers can tell us. That one is a bit hard because even the farmers, they are Kenyans.
I heard that there are some questions that are ethically unprofessional to answer.
Okay.
Some questions are
ethically
unprofessional to answer.
Yes.
Some guy asked me, a very good friend of mine, he told me a boat is sinking.
Yes.
Or 3 people are sinking.
Yes.
My child.
Yes.
My wife.
Yes.
And my mother. And you only have a chance to save one person.
Yes.
And all of them are here, they are listening to the kind of answer I will give. So my son is here, my wife is here, and my mother is here.
Yes.
So it's good to say some questions are ethically unprofessional to answer.
Okay.
So whether the government should side with the farmers,
let us leave it to the viewers. They can give us an answer. They can tell us what they think about it. We have come to the end of the show. We hope that you have learned something about inflation and how it affects our economy and everyone. And in case it is not clear to you, you can always reach out to us. We are in Facebook, in Instagram, in YouTube as Certified Business Solution. We hope that you'll do better now that you have known better. See you next time.